Welcome to the first episode of Awaaz, conducted by the Economics, Politics and Social Sciences Interest Group of IIM Kozhikode. Today, the topic of our discussion is to understand the structural reasons why the NPAs are caused, which is crippling the banking system currently, and also looking into the feasibility of the solutions that the government has proposed. For discussing the same, we have with us Dr. Rudra Sensarma. Dr. Rudra Sen is a professor in the economics area at IIM Kozhikode. He has done extensive research in the fields of banking and microfinance. He has also done various consultation projects in association with the Ministry of Commerce and also Niti Aayog. Welcome to the show, sir.
Thank you very much. My compliments to EPS group of IIM Kozhikode for this initiative, and I'm looking forward to this conversation.
Sure, sir. So, starting off the conversation, the current NPA amount that the Indian banking system is sitting upon is a figure upward of around 10 lakh crores, and this is 9.6% of the entire loans that are being given. Now, when you compare public sector banks in contrast to the private sector banks, we see that the NPA percentage of public sector banks is way higher compared to private sector banks like HDFC or Kotak Mahindra, which have an NPA percentage of approximately 2.58 to 1.54 percentages. And in contrast, we see that banks like Indian Overseas Bank and IDBI Bank have NPA percentages of around 25%. So, what do you think are the major reasons why private sector banks are able to perform well in comparison to public sector banks? And also, in continuation, is privatization of public sector banks a solution to this?
So let me start with a bit of history. So around the year 2002, we had something called development finance institutions such as ICICI, IDBI, a bunch of others like IFCI, IDFC. So their job was to do long-term finance for corporates and especially the infrastructure sector. Now, after 2002, the big ones were given the option of converting themselves into banks. So when they became banks, ICICI, IDBI, etc., they realized that retail segment is an attractive one to start lending into, and that vacated the space for PSU banks to start lending into infrastructure. So a simple answer to your question is the difference between PSU banks and private sector banks has been infrastructure lending, because this is the sector which saw tremendous growth between 2003 and 2010, and that's the period when PSU banks were also lending to this sector, earning good returns. But then after 2010, because of various reasons such as slowdown in project clearances, slowdown in the general economy, these loans started going bad, and PSU banks realized that they have got into a segment which they knew little about. So I wouldn't say just infrastructure, it's infrastructure plus poor lending practices in a segment which one did not understand. So that is what created the difference between PSU banks and private sector banks. Coming to the other question, therefore, as a corollary, would privatization of PSU banks help? I think in the long run, there is no other solution according to me. So we have to go there one day, because we have to understand that the heart of the problem is really not bad lending, bad government laws or poor regulation or business conditions. It is really governance of banks. So the governance of banks in PSU banks is very weak. They do not have professional boards, they do not have empowered CEOs, there are bureaucrats sitting on the boards instead of professional bankers. So with privatization, we will have professional boards running these banks and making lending decisions purely on commercial considerations. Okay. So with that, hopefully PSU banks can perform as good as private sector banks. But one caveat, that is not the panacea, because even private sector banks, mind you, have seen 450% growth in NPAs in the last 5 years. Yes. So while privatization could fix probably governance and the lending part, but the larger issues of economic conditions and regulation is going to be common for all banks in the industry.
So, drawing cue from one of the points that you mentioned, that private sector banks have been seeing an increase in NPA percentage as such. From the year 2013 to 2017, according to the RBI data, it has been found that the NPA percentage has increased steeply compared to all the previous years. And this was also the time when there was heavy focus on growth, high GDP rates as such. So, drawing parallels, does one conclude saying that whenever the country wants high GDP rates and fast and heavy growth rates, does it always lead to high NPAs? Or is it not the case? Is it something that we are missing over here?
I think there's a clear link between high loan growth rate and subsequent NPAs and slowdown in the economy. Research, including my own, has established a clear link. So the period that I mentioned earlier, 2003 to 2010, as you yourself said, was a period of high GDP growth as well as high loan growth. So credit growth rates annually were typically between 25 to 30% and upwards. But after 2010, when the slowdown happened, it's because the aggressive loan growth rates were accompanied by poor lending decisions. Because when the music is going on, you tend to neglect risk management, and the realization comes later, particularly because banking, unlike non-financial industries, is not a matter of selling a product with immediate cash flows. So in banking, you are selling almost a promise of future cash flows. And if you do that too aggressively without the proper credit appraisal, post dispersal monitoring, risk management, etc., then you are going to end up in problems. And that's precisely what has happened in India and several other countries in the past as well.
In the last few years, in the last 1 decade, prominently, we observed that banks are relying more and more on retail loans to drive their profits. And also, at the end of the day, what has happened is they started giving a lot of loans under multiple segments like automobile loans, housing loans, and also education loans as such. So, what has been observed recently, according to data, is that over the last few years, there has been a steep increase even in the retail loan NPA percentage. For example, in the education loan portfolio, the NPA percentage is as high as 11%. And also in the automobile, in the consumer vehicle and the commercial vehicle segment, the NPA percentage has risen to 6.6%. Earlier, we were concentrating on commercial loans, giving it to the corporate clients and all. We did not perform well. And then we shifted our focus to retail loans. Now there are signs of weakening of this system also, where the NPA percentage is again increasing. So, does it not highlight the fact that structurally there is something wrong that we are doing with respect to giving out loans? Is there anything fundamentally that we need to change?
Yeah, I think I'm glad you mentioned education, because that's one part of the retail segment where NPAs have been high, and interestingly, that is one part of the retail segment where PSU banks were doing bulk of the lending. So you see, PSU banks were once again doing something which probably they did not understand properly. So while it is easy to say that PSU banks don't understand infrastructure, which is probably what came out of my previous answer, but it's not just the segment, it is basically the lending practice. So education is an example where the government might have wanted to or might have encouraged banks to lend into, and PSU banks followed suit without understanding the market. So while it is the segment, it is also about whether you understand which is the segment that you are lending to. So that's the difference between a private sector bank, which probably would not get into something that they do not understand, but PSU banks would under government mandate.
So the other brother of retail loans is corporate loans, the bigger brother. So we have seen that the corporate loan growth rate has come down to such a low level. It's at a 13-year low. And analysts also believe that the recent increase in the corporate loan books is because of the requirements and the borrowings that they're making for working capital and not for capital expenditure. So, what do you think can the government do, or what do you think that the banks can do to revive corporate borrowing in the country?
This is a difficult question to answer because there are so many factors which would be required to come together to revive the capex cycle. But I think there are some green shoots of recovery we can already see. So, first point would be that capex cycle also depends on recovery of larger economic conditions. So, we are witnessing some recovery in GDP growth in recent times. Secondly, and most importantly, the IBC Act, which the government introduced last year, the Insolvency and Bankruptcy Code, that has allowed banks to take recourse to the National Company Law Tribunal to get their balance sheets cleaned up. So we are of course going through a transition phase where there is some pain to be seen because banks are being forced to clean up their books under IBC. But once the balance sheets are clean, they can start lending once again. And there are other larger supportive factors such as the GST, which has led to increase in tax revenues and efficiencies. We have also seen some revival in some indicators such as cement production, freight movement, auto sales, two-wheeler sales. Good monsoon and higher MSPs are reviving rural demand. So I think the recovery in capex is not very far, but it may take up to another 2 or 3 quarters from now.
We have this tendency of comparing the Indian story with that of the Chinese story. According to the IMF, China, whose economy is also dependent on borrowings, has an NPA percentage as low as 1.7%. Adding to it, China has also come out of a severe NPA crisis in the early 2000s. So, what do you think are the major steps taken by China to overcome this crisis, and what are some parallels that we can draw and that we can implement here in India so that we can solve our NPA crisis to an extent?
China is an interesting case. So, even keeping aside the questions over the data that gets reported from China, the model that they adopted is a government run asset management company which took over all the bad loans of the state owned banks, and therefore banks were able to reduce the NPAs on their books and continue to give out loans. So the government run asset management company therefore had these bad loans which they could then sell out slowly. Now that is a model which probably we cannot adopt directly because we do not have the Chinese system of the government directly owning all the banks as well as the asset management company. So we have a mixed banking system with government and private ownership. Another example could be what South Korea and Malaysia did. So they also had government run asset management companies which took over bad loans of banks, but in their case the banks were privately owned and foreign banks. Now in India, since we have the IBC Act which has allowed banks to take recourse under the Act and use the National Company Law Tribunal to address the defaulted loans, at this point of time I don't think we need asset management companies because banks are so far finding a good deal of success in with some haircut addressing the defaults, especially on the large loan accounts which the RBI identified among the first lot. So I think we can wait for a while to see how successful the IBC is, because I do not think the IBC and a government run AMC can coexist. Now we have tried the AMC model before. We had asset restructuring companies, ARCs, in the private sector. So the SARFAESI Act of 2002 actually allowed the ARCs to be set up in the private sector, and banks were allowed to sell the loans to the ARCs. But that model did not work, mainly because these private ARCs were small and the price which they were paying was what the banks were not happy with in selling the loans. So that model didn't work. Now we can have a government AMC, but not while the IBC is giving us signs of success.
So now coming to the solutions that the government has put in place. So you mentioned about the IBC and the SARFAESI Act, and recently there is ongoing discussion about a much controversial FRDI Act. So on top of all this, the government took a huge step in last year by recapitalizing all the banks. While recapitalization addresses the major capital requirements of banks for the immediate term, how does it change the basic way in which we are solving for NPAs? Does it change the bank's operations, or does it change the way in which we are giving out loans, in which loans are repaid, and also if loans are being defaulted?
You mentioned a few of the initiatives taken by the government in the past. If I may add to that, there was something called an Indradhanush scheme, which was supposed to empower public sector banks, which led to the Bank Boards Bureau being set up, which would improve the governance and management of PSU banks. Bank employees were supposed to be given ESOPs, which would give them skin in the game. Now, unfortunately, those things actually didn't work to the extent they were supposed to. Recapitalization is part of that package. Recapitalization was a promise which the government made in October last year to the tune of 2.11 lakh crore rupees, which they need to infuse into PSU banks over 2 years. Now that is something which is unavoidable. So as long as the government is the majority owner of PSU banks, it has to provide capital for lending to continue. Otherwise, we will have a further growth slowdown. So recapitalization in the short run is a necessary evil, but I think it just postpones the problem. It doesn't solve the problem which a structural solution can achieve. So I think we cannot avoid structural solutions. Eventually we have to look at privatization. We have to probably look at merger in the PSU banking sector, where some of the weaker banks could even be closed down, some of the larger banks can be recapitalized even more, and we can see fewer but healthier banks. So those are the structural solutions which will help in the long run.
Okay. If you were there in the BJP and you were part of the major advisory board, or you were part of the core committee that runs BJP, with 1 year remaining for the elections, and if you were given two options, either bank recapitalization or two, waiving of farm loans, which one would you choose? You only have one option.
Yeah, I think you saved the most difficult question for the last.
Yeah.
As an economist, you would expect me to say that bank recapitalization is the one which the government should do, because we need to revive the health of PSU banks, we need to get lending back and growth back. But you see, sound economic policy cannot happen in the absence of a political context. So the political context would demand that the farm loan waivers be given a priority, because going into election, the government has to accept that more than 50% of the population lives in villages. And not only that, even as an economist, rural demand is key. So if we have a collapse in the agriculture sector and the rural sector, we will not have growth overall, because there is rural demand which drives many of the FMCG and other companies, and the rural supply through agricultural production also is important for keeping inflation under control. And if we have larger economic recovery on the back of rural demand, probably that will also help to bring down NPAs and revive demand for credit. So between the two, I would have chosen recapitalization if it had come with structural reforms.
Okay.
But recapitalization on its own, as I said, is just going to postpone the problem. So in the short run, probably I'll go with farm loan waivers now, most reluctantly.
Okay. So any final words regarding this issue and regarding this topic that you want to say?
The final word is that banking is a very complex sector because of the inherent non-transparency, which is not there in non-financial sector, where you buy what you see. So banking by nature is so opaque, and the complexity is so much because you have multiple stakeholders. Here you have depositors, which are the public at large, and they are the primary stakeholders, unlike in any other corporate entity. So therefore the regulator, the government, society at large, it is in everybody's interest to keep the banking system healthy, and short-term solutions are not going to solve the problem. We need big bang reforms in banking sector.
Thanks a lot, sir. Thanks a lot for giving your valuable time amidst your busy schedule. We'll also be looking forward for further sessions with you. Thanks a lot.
It was my pleasure. Enjoyed talking to you.
Thank you. So that's it. This was our first episode of Awaaz by EPS IIM Kozhikode. Please stay tuned. Thank you.